from lack of liquidity. They therefore exhibit and have attached to them a high degree of risk, and associated with that we will margin these pairs at a different rate, simply to reflect the lack of liquidity and therefore the higher risk associated with trading in one of these pairs. My view, and you need to consider this given your own objectives, is that if you haven't traded currencies before, you steer clear of exotic or minor currency pairs. A lot of people refer to currencies as a currency cross. That is not necessarily correct. In the professional market, a currency pair or a major currency pair is something usually against the US dollar, and anything that's not associated with the US dollar, say for example the Aussie against the US dollar, is a major currency pair. Anything that doesn't have a US leg in it could be classified or is classified as a currency cross. Hence here the Australian dollar versus the Japanese yen is referred to as a currency cross. Similarly, the Aussie against the euro, or the Aussie against the pound, or the pound against the euro, not being a US dollar part, or US dollar not being a part of that pair, we refer to them as a currency cross. And similarly, you will get a two-way market and can place orders above or below the market if you so desire. Again, be very careful when you're dealing in currency crosses, or if you're looking to deal in currency crosses, that you take or make sure that the one part of the pair is not in a liquid such as the South African rand or the Mexican peso or something like that. All currency pairs will react and have one price. There's not two prices or any differential in price. The price is as quoted. It is a market price. You do need to be aware that it is an over-the-counter market. In other words, there's no exchange sitting behind this, as there is in, say, a futures or an equity market. The market is over the counter. Liquidity providers exist around the world. At Get, we use 20 different global liquidity providers in all our currency pairs. They provide a price to you which you can accept or reject, and therefore that is the market. Everyone in the foreign exchange market operates in this way. There's no exception to this. There is no exchange. The only regulation you will have in currencies is generally by the central banks, which sometimes will be influenced by government, sometimes will claim that they're independent. They will intervene in currency markets for economic reasons or for other reasons to protect the currency valuation in certain circumstances. This may be from a weakening point of view, where, say, the Reserve Bank of Australia may deem that the Australian dollar is undervalued at a certain level or is going to impact heavily on economic growth, foreign debt, the importers or the exporters or whatever, and they may purchase Australian dollars to support the value of the currency. Similarly, they may sell it as well if they believe that the value of the currency is too high and in turn is having an effect on the market. So, as with other markets that you may have been involved with, a bull market is when a currency pair is going higher in value. A bear market is when a currency value is going lower in value, and a sideways market is when a currency market is basically going sideways, as you can see on the right hand side there. So no difference in market direction, bull, bear, sideways, those sorts of things. Exactly the same when trading currencies as it is in other asset classes. I really would like you to take note of this this diagram here in regards to the margins that we apply to currency trading. It is heavily geared currency trading, and you need to take that into account. If you have an investment, if you have a deposit of $10,000 in your Get account or any other account with Get, and we margin you at 1%, then you can have exposure of up to $1 million. If For example, if I applied this to the Australian versus the US dollar for a $10,000 account at a margin of 1%, 1% being 10,000 being 1% of $1 million, you could have a face value exposure of $1 million in the currency. If we margin you at 2%, obviously that's double 1% and half the value, trading value, that you could trade on your account. Okay. For valuations of currencies, I'll come to on tick values and things like that in a moment, but this is a very heavily leveraged market, and you need to take that into consideration. Get is willing to discuss margins with you at any point in time, given your level of experience. If that margin is too low, we're happy to raise it, and if it's too high, we'll discuss and negotiate whether we believe that you can accept the risk of lowering margins. But generally you can expect your margin on currencies with Get to be either 1 or 2%, and obviously we can negotiate it higher or lower depending upon what you're actually looking for. Pips and spreads. As with any market, there will be a buy and a sell price. The difference between those two is called the spread, between the buy and the sell, or the bid and the offer, or the bid and the ask. In this instance, currencies, we've used the euro against the US here. For example, if you are looking to trade in this market or in this currency pair, then what you're really looking for is what is the difference between my purchase price and my selling price. You have a number of options here. You can either buy where someone is offering it to you, which is at 1.28754, or you could buy it at a lower level if you wanted to. But in this instance, this is what we use for a day trading screen. If you are happy with that level at 128.754, you could simply buy that. The 5 represents 1 pip. The 4 represents a half pip. We won't cover the half pips at the moment, but the 5 here being out to 4 decimal points. On $100,000, a point movement, in other words, from